Hundreds of millions of ounces worth of silver can trade as paper claims, while only a much smaller pool sits in the deliverable bucket at any given time. That mismatch is the heart of why people are even talking about silver shortage 2026, not because a screen price moved on a random day, but because the plumbing underneath the price can get strained. Today I'll give you 3 takeaways. First, how to read the basic inventory and delivery stats without getting lost in jargon. Second, which market signals tend to show physical tightness before headlines do. And third, a simple weekly checklist you can use to stay grounded. And there's one detail most people miss, the small line item that often shifts before inventory headlines hit social media. So stay with me and I'll explain it later. Before we start, a quick note: this is educational in general, not personal advice. Silver is volatile, and how you approach it depends on your goals, time horizon, and risk tolerance. Now, the key concept is that futures markets were designed primarily for hedging and price discovery, not for everyone to show up and demand bars at the same time. That's not a conspiracy, it's just how participation has historically worked. Most traders close or roll positions, and only a minority go through delivery. When that behavior changes, when more participants prefer delivery, or when industrial buyers try to secure supply outside the exchange, you can see stress. Think of it like airline overbooking. It works smoothly as long as not everyone shows up expecting a seat. The moment the show-up rate rises, the system has to adjust, by finding more seats, offering compensation, or changing the rules of the game. To understand the stress signals, you need to separate silver in a building from silver available to meet a contract. Exchange vault reports often split metal into categories like registered and eligible. In plain English, eligible metal meets certain standards and is stored in approved vaults. But it's not necessarily committed for delivery against futures. Registered metal is the portion that's been designated as deliverable, meaning it's the pool that can be used to satisfy delivery demands under the exchange's process. Those labels can change for routine reasons, so one-day moves shouldn't be treated like prophecy. What matters is the trend and the context. Is the registered category shrinking steadily over weeks? Are withdrawals leaving the vaulting system entirely rather than just being reclassified? Are deliveries rising at the same time? When those line up, it's more meaningful than any single dramatic chart someone posts. Now, why can silver prices drop even if physical conditions tighten? Because paper pricing is heavily influenced by macro positioning, real yields, the dollar, risk-off moves, and leverage. A wave of liquidation, say, from funds reducing exposure, higher margin requirements, or a broad sell what you can event, can push futures prices down, even while physical users quietly keep buying. In other words, the marginal price setter on a given day might be a leveraged trader, not a manufacturer that needs metal for production. This is where people get confused. They assume tightness must mean price up immediately. Historically, it doesn't have to happen that way. The physical market can whisper while the paper market shouts. The more useful question is whether physical tightness shows up as persistent premiums, longer delivery queues, higher financing costs to borrow metal, or an unusual preference for taking delivery rather than rolling contracts forward. Delivery mechanics are the next piece. Each futures contract has a delivery process with specific notice periods. Most participants never touch it, which is exactly why the system can support a large amount of open interest relative to registered inventory. But in months when delivery interest rises, or when traders suspect physical supply is more valuable than paper exposure, those notice periods become pressure points. The exchange and clearing ecosystem can respond in a few ways. More metal can be moved into registered, participants can be encouraged to roll, spreads can widen to incentivize certain behavior, or in extreme circumstances, cash settlement clauses and alternative delivery pathways can be used. None of that automatically means catastrophe, but it does mean the market is adapting. If you're tracking silver shortage 2026 narratives, focus less on one dramatic number and more on whether repeated delivery months show unusually high standing for delivery compared with prior years, and whether the registered category keeps failing to rebuild. Here are the global tells that tend to matter more than viral posts. One is regional physical premiums, when buyers in one hub consistently pay more for actual bars and coins than the headline futures quote elsewhere, beyond normal shipping and fabrication costs. Another is the futures curve itself. When near-term contracts trade unusually strong relative to later months, it can hint that immediate availability is valued. A third is leasing and short-term financing costs for silver, what it costs to borrow metal or borrow against it. This is the detail most people miss. Financing conditions can tighten before the average investor notices anything in a vault chart. If short-term lease, borrow rates jump, it may indicate that holders are less willing to part with metal, or lenders want extra compensation for perceived scarcity or return risk. None of these indicators alone is definitive, but when two or three move together, premiums persist, near-term spreads strengthen, and borrowing costs rise, you're no longer just watching a story, you're watching a mechanism. Next, the demand backdrop. Silver isn't just a monetary metal in the way many people talk about it online, it's also a key industrial input. Demand can rise from solar manufacturing, electronics and connectors, electrification, and high-density computing infrastructure. The important nuance is substitution. For some uses, engineers can thrift, using less silver per unit, redesigning components, or shifting to alternatives. For other uses, substitution is harder without sacrificing performance, reliability, or certification. That's why industrial demand can be sticky even if prices rise. The metal cost may be small relative to the cost of downtime, warranty risk, or redesign cycles. Example: imagine a manufacturer producing high-reliability electrical components for critical systems. Even if silver prices jump, the cost increase per unit might be trivial compared with the cost of a failed component, so they may keep buying and instead cut costs elsewhere. This doesn't guarantee rising prices, but it helps explain why physical offtake can remain steady even during paper market sell-offs. On the supply side, silver has constraints that make quick responses difficult. A large share of global silver output is produced as a byproduct of mining for other metals. That means silver supply doesn't always surge just because silver is more expensive, because the production decision may be driven by copper, lead, zinc, or gold economics. Primary silver projects also have long lead times. Permitting, financing, construction, and ramp-up can take years. Recycling helps, but it's not a magic lever. Much silver is used in ways that are dispersed, hard to collect, or uneconomical to recover quickly, especially in modern electronics and industrial applications. So if demand rises faster than supply for a period, the market often balances through inventories, higher premiums, substitution over time, demand destruction at the margins, or some combination. This is why the phrase silver shortage 2026 keeps coming up. People are trying to map whether the market is approaching a point where above-ground buffers and available for delivery pools get uncomfortably thin. Macro conditions can amplify everything. Higher real interest rates can pressure precious metals prices, even when physical demand is fine. A stronger dollar can do the same. On the other hand, currency volatility, liquidity events, and rapid deleveraging, especially when trades unwind across markets, can create short bursts where futures pricing becomes disconnected from local physical conditions. Geopolitics and industrial policy can also matter if major producers adjust export rules, stockpiling behavior changes, or strategic industries secure supply via long-term contracts rather than spot markets. I'm not going to claim any single election, central bank action, or headline will trigger a guaranteed outcome, but I will say that silver sits at an intersection of industrial policy, energy transition spending, and financial market positioning, so the path can be jagged, with periods where the paper price leads and other periods where physical tightness shows up first in premiums and spreads. So what could 2026 look like in realistic scenario terms? Scenario 1 is orderly adjustment. Inventories fluctuate but remain functional, delivery demand stays within historical ranges, and price discovery remains anchored to major exchanges even if physical premiums widen occasionally. Scenario 2 is a stressed but managed market. Delivery interest rises, registered inventory rebuilds only with difficulty, premiums persist in certain regions, and spreads lease rates stay elevated. Yet the system continues operating through incentives, arbitrage flows, and policy responses by market participants. Scenario 3 is disorderly. Repeated delivery periods coincide with shrinking deliverable pools, confidence erodes in paper settlement terms, physical buyers bypass exchanges more aggressively, and pricing becomes more regional, meaning silver effectively trades as different products depending on form and location. None of these is guaranteed, and timing is the hardest part. Markets can remain stressed longer than most people expect, and they can also normalize faster than the loudest narratives suggest. Here's a practical framework you can use without getting pulled into extremes. 1. Track deliverable inventory trends over weeks, not days, especially the registered category and whether metal is leaving the system versus being relabeled. 2. Watch delivery behavior. Are more contracts standing for delivery versus rolling, and is that pattern repeating? 3. Monitor physical premiums where you live. Coins, small bars, and wholesale quotes if you can find them, because retail premiums can be distorted by fabrication bottlenecks, but persistent wholesale tightness is more informative. 4. Check market-based stress signals, near-term futures spreads, signs of backwardation, and reported lease borrow rates when available. 5. Match your exposure method to your actual goal. Physical metal has storage and premium costs. ETFs and futures have structure and counterparty considerations. Miners add business risk. The common mistakes I see are using leverage in a market known for sharp swings, ignoring liquidity and bid-ask spreads, assuming a premium guarantees anything about the future, and treating one indicator as a single proof of shortage. Let's recap what matters. Paper volume can dwarf deliverable supply without being fraudulent. It's how participation has historically worked. The more important question is whether behavior is changing, delivery preference, persistent physical premiums, and tighter financing conditions. Industrial demand can be sticky, while supply can be slow to respond, especially when silver is a byproduct. And macro forces, rates, the dollar, and liquidity can push prices around in ways that look inconsistent with the physical story in the short run. If you're following Silver Shortage 2026, focus on a dashboard, not a headline. If this helped, like the video and subscribe for more market structure breakdowns. And I'm curious, which signal would make you take the story more seriously? COMEX silver inventory trends, global premiums, or lease financing rates? One more risk reminder before you go: silver can move violently, leverage can magnify losses, and being early can feel the same as being wrong for long stretches. This is educational, not financial advice.